Good afternoon, everybody. Welcome to my channel, Data-Driven Decisions. Today we're just going to talk about Dave Ramsey and his vague investment plan that, um, it, you know, it for me, I use Dave Ramsey. I like the guy. I still listen to him. I think he's puts great sense into people. Getting out of debt first before you invest is a rock solid plan that I followed through in the beginning of my financial journey. And you know, it, that's great. I love not having much debt and never paying much not paying interest on debt. Um, and just having that, building savings and having a large safety net for inevitable catastrophes that will cost you thousands along your journey of life, Uncle Sam or whatever you call him. So Dave Ramsey's a good guy. I like him. I don't think his financial plan is bad. He says I'm looking at baby steps right now. It kind of lists out, we're talking about baby step 4. What does he do to invest? Pretty simple. He says break it down into 25% growth in income, 25% in growth, 25% in aggressive growth, and 25% in international. Um, what I don't like is that, why don't you just tell us exactly what fund you're in exactly? Like, let's see the portfolios. Um, if he gave out the exact template of what to do, I'd follow it. But um, all in all, Dave Ramsey's rather vague with this. I can see how, I could certainly find a growth in income ETF, find a growth ETF, find a aggressive growth ETF, and then, international VXUS. I know that one already. I'm sure somebody on the internet has that information, and I think that's a solid plan. I might want to do that with a lot of my portfolio. I do different things. I follow different rules, investing in certain, funds. Um, what I like about Dave Ramsey, it's all stocks. He mentions nothing about bonds. The other, cult of financial experts, and they all say the same thing. Starting with Jack Bogle, Burton Malkiel, Charles Ellis, William Bernstein, um, those Richard Ferry, Larry Swedroe. There's many others. It's all these books. I've read plenty of them, not all of them, but uh, there's a camp of investment experts, and that's what I follow, the Jack Bogle Club. And I recommend, people who follow Dave Ramsey, and you're kind of in my same boat with, you like following Dave Ramsey, you believe in that plan, but you come to step 4 and you just think, I don't know what to do. It's vague. Um, I would agree. I think, maybe after this video, I can try to find what would be the ETF equivalents of the Dave Ramsey portfolio. I'm sure somebody out there has figured that out, and if not, then I'll figure it out and show it. And I'd like to see how that portfolio does for me. I think it would do great just because it is all stocks. But honestly, what to do with your money. I've analyzed a lot of export portfolios. I've and one of the most basic portfolios is VTI, all of it, Vanguard Total Stock Market Index. It's a very, very low cost fund, and it's the entire stock market. I do suggest you invest with Vanguard. That's really the safe space for private investors that want to do it on their own without having middleman. Dave Ramsey stated many times, there's nothing wrong with paying a premium to get expert help from financial gurus, and really that's kind of like the pothole in the road with Dave. You can't argue that. He does say to go with active management, and all of me screams at that, because from all I've read with Jack Bogle and William Bernstein and Burton Malkiel, that's like the no, 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 no. That's the worst thing you can do, because active management comes with very high fees, and Burton Malkiel has proved many times over and over that active managers can't do better than random monkeys throwing at a dartboard. It's just a random walk down Wall Street, as he says. It's random, your return. Don't think these people have any skill. They don't. And on average, you're just going to get the average return minus 3-4% in expenses. Putting you probably around 6-7%. Maybe less. I think the average stock market return seems to be like 9%. That's kind of what I'm reading about. I mean, some say 10, some say 11, some say 12, like Dave. Dave says you can get 12% returns year over year, and that's what he gets. That I think is also a lie. I would like to know exactly what he's investing in and let me see its returns. But according to Burton Malkiel, it's a random walk, and there's no such thing as that all-performing mutual fund that's always beating the market time over time. Sometimes it goes above, and most of the time it goes below, because it's so hard to predict the market, and it's so hard to beat the computer algorithms that are really making good decisions. That's kind of what I would want to get on board with is, there are funds out there that are just managed by algorithms that just take advantage of every bad decision that takes place in the market. I know people can do that, but not like machines can. So I don't like to diss Dave Ramsey. He's helped me a lot. I'm in a good place, not great. He'd look at my assets and liabilities. The fact that I use credit cards, the fact that I got in debt for a truck, which definitely was a bad move, but my car broke down and I needed something, and I wanted to go for what I really wanted, and I'm happy I had it. But you know, to counter what Dave Ramsey does, if you're new to investing, you want to know exactly what to do. Just all your money, a VTI, Vanguard Total Stock Market Index, that will do better than 80% of people year over year, and in 20 years, it will do better than most, like 99% of people. Rock bottom expenses, just put all your money in that. And I don't think Dave Ramsey's plan is bad. I just think it's vague, and then the pothole in the road. He does tell you to invest in active management, and that's really where I scream and say, no, this is wrong. Don't follow Dave. You got to do it yourself. You got to invest yourself. You got to just invest in index funds, and just invest in the total market, and just keep putting money in, and never really trading because of what's going on in the market. Yes, there's asset allocation. You might want to do that maybe every 6 months to a year. You just adjust your portfolio based on what goes up and what goes down. You buy more of what went down, you buy less of or you sell what went high. So you're really taking advantage of selling high and buying low just within your own basket of portfolios. Um, you know, if you know, if you want to have an asset allocation, that's what experts recommend, and I have that with, my big portfolio, my 401k. It's a mix of about 30 index funds, and it's up of um, 20 expert portfolios, and it was analyzed from a sample size of about 554 portfolios from experts. Um, you know, that's I did that. I have some videos on that. But to the new investor who's just starting out, what to do: put all your money in VTI, and focus on just putting more and more and more in it, And, that's the best stock you can buy. If, Jack Bogle on Consuela Mac, she always asks that question, what do you invest in? If you could do one index fund, mutual fund, one thing, what would it be? Jack Bogle's answer is put all your money in VTI. And if you don't know Jack Bogle, you should know him when it comes to financial advice. He is like the Jesus Christ. He saved the industry from active management and from speculation by creating Vanguard and allowing private investors like me, people who just want to do it on their own, the freedom to do that and to do it at rock bottom expenses. Because I'm an investor at Vanguard, I guess I'm part owner. That's what they say about the company. It's owned by its investors, not by shareholders. So it's kind of obligated to look after its investors because that's who owns it. So Dave Ramsey's great. Great. I followed his plan. Get out of debt. Follow the debt snowball. Obviously, pay the highest one first and not just the lowest one. Go for the one with the highest interest rate. Knock that one out with intensity. And credit cards are good. You don't want it to increase your spending, which it does. Statistically, when you have a credit card, it really desensitizes the value of that money, and you're much more easier to just spend on it recklessly, and that's bad. And that's a good reason why you don't want your credit cards, and that's what Dave Ramsey says. But just to protect yourself against fraud, which is just all over the place. I mean, 20 times a year, I probably get fraudulent contact, whether it be an email, a text message, a phone call. It just hits you at all angles, and you got to be really careful. And sometimes you do get bit. Sometimes the wrong people get a hold of your credit card information. And when you just call your credit card company and say, hey, this and that is fraud, please give me a new card and get rid of those, and they do it right away. And you don't get that with debit cards. So that's a big reason to have credit cards. But yeah, you do want to watch out for, the desensitization of your money. I don't spend cash because I like to have a trail on all my transactions. So I don't spend on cash. But, Dave Ramsey says, the meaning of cash is so much more than the same value just in on a computer. However, there's no need to carry cash in this day and age. So, Dave Ramsey's good. He's got a lot of good advice, and I follow him. But I just felt like baby step 4 was very vague and what to do. And then, he tells you to invest in active management, which is just a no for me. And I'll make another video that takes his portfolio and turns it into an ETF portfolio. And I think I want to check out that and maybe invest in that, and really kind of have a Dave portfolio. But, sadly, with all of Dave's advice, I didn't know how to carry out his advice because he doesn't give the direct funds of which to invest in. He's just vague in the area, plain and simple. He's trying to lead you towards active management, to just do what everyone is doing. Most people do that, but you're going to be paying a lot for that. So you want to avoid that. You want to do it on your own. You want to just be a private investor. And yeah, so that's where Dave goes wrong. I think he does intentionally lead his followers into active management. And if you really follow the experts in finance, Dave Ramsey is not really an investing expert. He's a personal finance expert, I think. But when you get to the investing experts, Jack Bogle's number one. You listen to him. He's the one who really you got to listen to and follow his plan. So, I hope this helps. This video helps for new investors. Go for VTI. That's what Jack Bogle says. That's the simple plan to follow. But if you want something more sophisticated, watch my other videos. I show off some of my other sophisticated investment plans. All right, here we go. I got Dave Ramsey's baby step portfolio with ETFs, thanks to Portfolio Einstein. I love this site, and it has what I'm looking for, and that's the Dave Ramsey portfolio in ETFs. So, if you do want to follow the Dave Ramsey plan of investing, but you don't want to use helpers, this is what you would invest in this exact allocation. So 12.5% US large cap, 12.5% dividend growth, 25% small cap, 25% mid cap, and 25% international, VUE. That's including US. So yeah, that, I think, I want to start accumulating some savings and implement this plan and try to do it on a value averaging basis where I take advantage of the low months and buy more, and I take less advantage of the good months and buy less, and figure out how to do the proper asset allocation. The one, what's it called, the value investing portfolio I have, I'm only investing in VTI, but I didn't feel like figuring out how I was going to manage the asset allocation. But for my next one, I want to show that and do that. So, my next plan would be to build out this Dave Ramsey portfolio off of a value averaging plan and show you how the asset allocation can be easily implemented. Alrighty, thank you. Bye. Okay, looking at the return of Dave Ramsey's baby step portfolio, it's returned since 1989, so like 35 years, is 9.3%. And this plot measures return and risk of about 550 portfolios, and we just get to measure that up against 9.3. Is quite high. You see it's definitely doing better than most portfolios. Unfortunately, what I don't know is the risk or the standard deviation of Dave Ramsey's portfolio. So I don't know where it measures on the risk curve. I bet it's somewhere around 11 and 13. It's probably got a bumpy ride, which is fine. It is an all stock portfolio. It does do a lot of small cap in it, which is great. I do recommend the ETF portfolio. Don't seek helpers. Don't seek financial advisors. Do it yourself. You can join any investment platform such as Vanguard, Fidelity, Charles Schwab, JP Morgan Chase, Robinhood. You really could do it anywhere, but invest in ETF funds. The ones we recommend is right here. If you want to follow Dave Ramsey and do it the ETF way, doing Dave Ramsey the Jack Bogle way, this would be your portfolio. And you see right here, 9.3 is its return. Drawdown, that's just the lowest year, 40%. That is quite high, telling you that it probably is high risk. This expense ratio is rock bottom, 0.12%. That's 0.12%. That's really low. If you want to just, if you're an ETF person, I recommend Portfolio Einstein. Look on this website, look at these expert portfolios, try to build your portfolio off of the portfolios you like in Portfolio Einstein. And it's easy to aggregate, multiple portfolios into one portfolio by just doing the averages, or you can even do weighted averages. But I hope you like this. So once again, we don't know where Dave Ramsey is on the risk side of this equation, but he is. His portfolio of 9.3. There's only about 20 other portfolios that have a higher return than that. So it is a rather good portfolio with return. So I do recommend it, and I look forward to potentially building it for myself. I need to figure out a way to bring in more money while spending less money. So increase my cash flow in both directions to first get out of debt and then get out of savings. So I'm definitely years away from building any new portfolios. I do want to get out of my debt. I do have a truck loan. I have some credit card debt that I'm not paying interest on yet, but if I don't, I will. So baby steps. But yeah, Dave Ramsey's portfolio is pretty good. I always had a hard time with his portfolio plan because it's vague, but I did just kind of do my research and found the ETF portfolio that matches what Dave Ramsey recommends. And looking at it on this plot, it is a rather high performing portfolio. So definitely one to pick. So go Dave Ramsey. Have a good one.